Today we'll be looking at measurement of non-controlling interest. How do we measure non-controlling interest? The standard provides two methods to measure non-controlling interest, and the first method is what we call the fair value basis, or what we call the full Goodwill method. And how do I determine my NCI using this method? I need to get the number of shares that is owned by the non-controlling interest multiplied by the share price of the subsidiary. Very easy. I determine the number of shares that belongs to non-controlling interest and I multiply by the share price of subsidiary. Aside from this, we can also use the proportionate method, or what we call the partial Goodwill method. Using partial Goodwill method, to get our non-controlling interest, we just need to know the percentage that is owned by the non-controlling interest, multiply by the net asset of subsidiary at the date of acquisition. So I need to know the net asset at the date of acquisition, and I just multiply by the percentage holding of NCI. That's all. Now, we said fair value basis is the same thing as full Goodwill method. Yes, we call it a full Goodwill method because when we use fair value basis to measure NCI, any goodwill we get in the question belongs to both parents and the non-controlling interest combined. But using proportionate method, we call it partial Goodwill method because any goodwill that we get from computing our NCI using proportionate method, such goodwill belongs to only the parent company and as such not to everybody, and that is why we said fair value basis is the same thing as full Goodwill method, while proportionate method is the same thing as partial Goodwill method. This will definitely lead us to impairment. We said if fair value basis is being adopted, what will happen if there is impairment? Impairment will be suffered by non-controlling interest if we use any fair value basis, because we said the goodwill we get as a result of measuring NCI using fair value basis belongs to both parents and the non-controlling interest, right? So as such, if that goodwill impair, the non-controlling interest will also suffer part of it, because the goodwill belongs to both the parent and the non-controlling interest. But what about if we have measured our non-controlling interest using the proportionate method? Will they also suffer part of the impairment? The answer is what? No. Why is the answer no? Don't forget, we said using partial Goodwill method, that goodwill arising in that our calculation belongs to only the parent company, and as such any impairment on such goodwill should be borne by only the parent company. Very easy and straight. How can we illustrate this in an examination condition or in figure? Let us pick a simple example to illustrate all this. Question 1 says Libya has just acquired 70% of the equity shares of Tripoli for $800 million, when the net asset of Tripoli were $600 million. Tripoli has 100 million equity share with a share price of $9 each. Required 1. Calculate the goodwill arising measuring NCI as acquisition on a fair value basis. 2. Calculate the goodwill arising measuring NCI at acquisition on a proportionate basis. So coming to my solution, very easy. We need to know our group structure, which is very straight in this question. We are told that Libya has acquired 70% of Tripoli. So which means Libya acquires 70% of Tripoli. And don't forget, non-controlling interest is the portion of the equity capital not owned by the parent company. So my non-controlling interest will be 30%. Now we want to determine goodwill. If we measure NCI using fair value, and if we measure NCI using proportionate basis. Very easy. Now to determine my goodwill, we already know from our past solutions. Now we said fair value of consideration transfer by parents. Coming to my question, we are told that Libya acquired 70% of Tripoli for $800 million. So the fair value that the parent company transfer to the subsidiary for acquiring that share is $800 million. Add what? Non-controlling interest. Let me remind you of something again. We said when we are using the fair value basis, two things are common. Either the examiner give you the fair value of the non-controlling interest, or you are given the share price of the subsidiary. Now if I come to this place, we are told that the total shares available in Tripoli is 100 million shares, and those shares as of today cost $9 each. So whenever you see the share price of the subsidiary, we are meant to use the fair value method except otherwise told. And how do you go about it? We know it is very easy. I want to know how many shares belongs to non-controlling interest. Look here, if the total shares in Tripoli is 100 million, and from our group structure we say that non-controlling interest own 30% of that equity, so which means out of 100, NCI own 30%. So in this case we can say that they own 30 million of those shares. Now if you want to measure using fair value, how much can we sell it in an active market? Currently in the market, the share price of the subsidiary is $9. So multiply by $9 give us 270. Very easy. So what you just need to know is how many shares belongs to non-controlling interest multiplied by the share price of the subsidiary, and we get our 270, giving us a total of 1070. After that, what do? We always less the net asset of subsidiary at the date of acquisition, and as given to us in this case, we are told that the net asset of Tripoli was 600 million. Less than 600 million give me my goodwill of 470. Easy and straight. That would be my goodwill if I'm using fair value basis. Now let us look at second one. We are told to also calculate goodwill when we are using the proportionate method. Easy and straight. I will come here. I am to repeat the same thing. Coming to this place, what do we say? We say fair value of consideration transfer by parent, still 800, right? But don't forget, whenever you want to measure non-controlling interest and the question told you using proportionate method, very easy. You just multiply the percentage holding by the non-controlling interest multiplied by your net asset at the date of acquisition. I get my net asset at the date of acquisition multiplied by the percentage holding by NCI. Percentage holding by NCI is 30%. And if you check what is the net asset at the date of acquisition of Tripoli, 600 million. So 600 times 30% gave us 180. And if you less the net asset of subsidiary as acquisition, it gave us 380. Now there is something you need to know. If you check the difference between 470 here and 380 here, you will see the difference is 90. And now the question here says that explain the difference between the two measurements. The difference here is 90, and this 90 is as a result of how we measure our non-controlling interest. If you check here, my NCI here is 270 million, my NCI here is 180 million. The difference between the two is 90. That is the difference between the computation of these two, and that is why the standard says whenever you use proportionate method, the goodwill we got here belongs to only the parent company,
And as such, if there is any impairment using proportionate method, that impairment will be suffered by only the parent company alone. But if you come here that we have 470, this goodwill belongs to both parent company and the non-controlling interest. If there is any impairment when you are using fair value basis, automatically that impairment will be suffered by both parents and NCI. Now, let us see if this is actually true. We said this 380 belongs to only the parent company. Let us prove it again using this alternative solution. In my alternative solution here, we want to say that whenever examiner told you to use proportionate method, you can actually get your goodwill using this short form. I will just come here, fair value of consideration transferred by parent 800. Don't forget, the net asset of this subsidiary is 600 million. And if we are talking about parent shares alone, parent own 70% of this company. So if I own 70% of this company, automatically I own 70% of the net asset of subsidiary. So 70% of net asset of subsidiary will give me 420, giving me goodwill to be 380. So using this alternative method and using this method will give us the same thing. So we will look at a more complex example in the next question. Question 2 says, Mount acquired 60% of Everest share capital for $900 million when the net asset of Everest were $800 million and the market value of Everest share $5. Everest share capital of 200 million equity shares. At the reporting date, the net asset of Everest are $950 million. Mount has retained earnings of $500 million and the goodwill has been impaired by $100 million. Required. On the basis of measuring NCI acquisition at fair value, calculate at the reporting date the goodwill, NCI and group retained earnings. So let's start. The group structure is very easy. In this case, we are told that Mount acquires 60% of Everest share. Automatically, non-controlling interest will be 40%. So in this case, do I have the net asset of subsidiary? Yes. We are told that when the net assets of Everest were 800 million, that is, at the date of acquisition, the net asset of the subsidiary is 800 million. So at the date of acquisition, my net asset is 800. Now, we are told also at the reporting date, the net asset of Everest are 950 million. Coming here at the reporting date, the net asset is 950. I told you in our previous video, the difference between our amount at the reporting date and our amount at the acquisition date give us our post acquisition. But that is not actually where we are told to go. But I just need to do this for us to make this work easy for us. So we have our group structure and our net asset. Now we can go to the computation of our goodwill. But we have to know at the back of our mind here that we are told to measure non-controlling interest using the fair value basis. And how do you go about that? I told you, either the question give you or you are given the share price of the subsidiary. Now in this case, we are told in this question that Everest, which is our subsidiary shares, is being sold at $5. So if I come here, I will have fair value of consideration transferred by parent, which is 900. Coming to this question, we are told here that last year Mount acquired 60% of Everest share for 900 million. So the fair value of consideration transferred by parent is 900. Add your non-controlling interest. When I'm using my fair value basis, what do I need to do? Get the number of shares that belongs to the non-controlling interest. Now check this question. We are told that the total shares available in the subsidiary company is 200 million equity share. If I have 200 million equity share available in the subsidiary, and according to our group structure, my non-controlling interest own 40% of that share. So how many shares belong to my non-controlling interest? That is 40% of 200 shares. Now, how much is the share price? $5 multiplied by $5 gave me the value of my non-controlling interest to be 400. Summing it together give us 1,300. What do you do next? You less your net asset of subsidiary as the date of acquisition. Coming back here, this is my net asset at the date of acquisition, which is 800. If I less my 800 here, I will have goodwill at acquisition to be 500. And if you check, the question says that there is impairment. Checking this question, the question says that goodwill has been impaired by 100 million. So lessen my impairment, give me my goodwill at the reporting date to be 400. Very easy and straight. After this, what do? We go to the computation of non-controlling interest, and we'll start. Non-controlling interest as calculated in our goodwill, we calculated our non-controlling interest to be 400. And don't forget, we said that whenever we measured NCI using fair value, any impairment suffered will also be shared by the non-controlling interest, because the goodwill belongs to both the parents and the non-controlling interest. So if there is any impairment, the non-controlling interest will also bear the burden of that impairment. Unlike when we are using proportionate method, whereby any impairment will be suffered by only the parent company. In this case, the non-controlling interest will take 40% of that impairment figure, which is 100, giving me 40. And our post-acquisition profit, because they own 40% of this business, any profit we have in this business, they are entitled to 40% of it. So 40% of post-acquisition profit is 150, which gives me what? 60. Summing it together gives me 420. So when I'm consolidating, my non-controlling interest will be 420. And after that, I can go to my retained earnings. Balance brought forward of retained earnings. Come back to your question. The question says, Mount, which is the parent, has retained earnings of 500 million. So balance brought forward of Mount's retained earnings, because don't forget that when we are consolidating, the retained earnings we calculated is for the parent. So balance brought forward here is 500. Don't forget, any impairment when we are using fair value basis to measure NCI will be suffered by both parent company and the NCI. That is why the impairment here is 60% times 100. So the parents will suffer 60 out of it. And again, the post-acquisition profit, the parent company will gain 60% of that. So post-acquisition profit is 60% of 150, which gave me a total of 90. And our retained earnings is 530. So if I'm preparing my consolidated statement of financial position, I will have consolidated 420 and also 530 as my non-controlling interest and retained earnings respectively. Now, let us do the same thing, assuming the examiner wants us to use the proportionate method. So how will the proportionate method be? So looking at my goodwill again, all of us know how to calculate goodwill again, which is fair value of consideration transferred by parent, which is 900 as given to us. Fine. The only thing that changed is how I measure my non-controlling interest. Let me remind you again, if you are using proportionate method, you multiply the percentage holding by the non-controlling interest multiplied by the net asset of subsidiary at the date of acquisition, not at the date of reporting, at the date of acquisition. And our net asset at the date of acquisition is 800 multiplied by 40% give the value of NCI to be 320. Summing it together give me 1,220. Easy. What do? You less the net asset of subsidiary as the date of acquisition, which is 800, giving me my goodwill at the date of acquisition to be 420. But we are told that impairment is 100, giving me that my goodwill at reporting, if I'm using proportionate method, will be 320. Easy and straight. So after that, I can compute my non-controlling interest. Balance brought forward or as calculated. We calculated here that our NCI is 320. I'll bring it here, which is 320. Don't forget, I said whenever we are using proportionate method or what we call partial goodwill method, any impairment will not be suffered by the non-controlling interest, because the goodwill we get using proportionate method belongs to only the parent company. As such, any impairment should be suffered by only the parent company. So that is why impairments won't come into this place. But don't forget, post-acquisition profit, NCI will take part of it. So 40% of post-acquisition profit, which is 150, will give us a total of 60. Summing it together, our NCI that will go into our consolidated statement of financial position will be 380. And after this, we can calculate our retained earnings. And what will be our retained earnings? Balance brought forward, as given to me in this question, is 500 million. So retained earnings is 500. And now I can move on. So we said when it is proportionate method, all the impairment belongs to the parent company and as such should be treated to the parent retained earnings. That is why coming here, the entirety of the impairment is suffered only by the parent, and that is why I charge 100 to this place. So also they need to get part of the post-acquisition profit, and our post-acquisition profit is 60% of 150, giving us 90, and my retained earnings at the end of the day will be 490, which is easy and straight. You can see the difference when we are using fair value basis and we are using proportionate basis, or what we call partial goodwill basis. These are things that are very easy. Just understanding the principle will go a long way to help you prepare for your exam. Don't forget to subscribe to my YouTube channel.